I did, well, because I looked at it, it's really familiar, but he didn't say, oh, John, like, he didn't say, oh, sorry.
What he told me this morning is that he asked you for advice and you told him not to give it.
It's true.
Well, you told me to say
Well, no, my actual goal is I ask people, why do you want to get through? Because I think there's some reasons that are awesome, and some reasons that are less awesome. And I think I have a little bit else for you. The one thing we know about the idea is like, this is such an exciting topic. You're putting yourself into a pool where you maybe less differentiated in the near term. Yeah. So that's not adding other value for you. Just because you feel like I want to, this will help me get a job. Just like, well, just realize this is that one other day. It's the side effect of the fact that this is so I had a great story you'll appreciate from Peter Knight from Generations. So his son is at Hobbs, and so it was like applying to see if they get to his clubs, so he was applying. We actually created this new social impact position within the clubs. I didn't get it. I was really bummed that I don't think I got it. She's someone who worked for us. Yeah, it was very funny. It's like, well, they're just like not supposed to be. No, but an email from you are lucky. It's a chip like hops. There's no real chance. Yeah, I'm gonna find out. Well, we changed formats last minute. Well, no, she just did. I'm gonna interview you.
So you're gonna do it?
Well, we did it. And I'm like, this was great. Can we just do that? Because I had a whole speech written. I even had jokes.
Wait a minute. Can I take time for a joke now?
I'll try to find ways to insert it.
Jokes are good.
And I think the good news is we can give this over here. Hopefully get premieres.
Yeah. Yes. Other program.
You got that. I did
Got that. Yeah, what did you do? I
You've gotten a head start in the evening. Like, you have the glass of wine.
But I told them, well, I'll see you on Wednesday. Tomorrow.
That's very under, just like it gets overwhelmed by you never anticipate
Like I use like the post that sort of surprising the thing that gives that pivot more just like the I mean, the thing is, if I had time, it's just like, it's a very unique lens. It's too easy to latch on to, but it actually drives the wrong behavior.
I would not have given out the actual.
Are you just really, really You've done what you can. That's what you have
Shall we get started? Do you want to sit while I introduce you?
I will sit.
All right. So, our big plan is going to sit. So welcome everybody to our 5th official K-Sci 3 speaker. Hence the brand for the slide. So we are taping tonight, so I'm going to say a few words for the tape. As many of you may know, I'm Kathy Clark. I'm faculty at CASE and help run our Impact Investing Initiative, which is K-Sci 3, which is in its 3rd year of creating a rich set of resources and activities for MBA students, entrepreneurs, investors, funders, academics, and policymakers. And in addition to our coursework and research, we have a fellowship program which this year has nearly 40 MBA students working on consulting projects around the globe. So first, how many people in the room are a K-Sci 3 fellow or associate? So we have almost a bunch. Yeah. So maybe we'll get a chance to talk to them, or they'll ask you some questions about some of the exciting things that they've been doing that relate to your work. I also wanted to mention briefly a new book that I and my colleagues are releasing next week. It's called Collaborative Capitalism and the Rise of Impact Investing. It's a short ebook, so low threshold to read this one. You could read it in an evening. And it's a small taste of a book that we're producing for the fall. I wanted to mention it because one of the themes, the book is about how impact investing relates to mainstream finance and what some of the trends are that are actually cross-cutting through both of those. And one of the trends that we talk about is this idea of outcome buyers, people who are thinking about how they invest for outcomes. And usually outcome buyers are not, if they're impact investors, they're not just after outcomes, they're also after impact. But we think about, who are the different outcome buyers in society. Governments are outcome buyers, which we know from our project with USAID, working with global health entrepreneurs. Foundations are outcome buyers. And companies and investors are becoming outcome buyers as well. And I wanted to mention that because I think our guest tonight is actually one of the people on the planet who has done the most work in trying to help outcome buyers meet their objectives in a sophisticated way. So I'm pleased to introduce John Goldstein, who's Managing Director of Imprint. They're a registered investment advisor focused exclusively on impact investing. And the firm works with foundations and families and offices to customize their impact investing products. And John is going to tell us a lot about that. His previous life, as far as I can determine, he was a management consultant and ran an advisory firm for policy intelligence, and has also
the world's most expensive newspaper.
Yeah, really? Which was?
Medley Global Advisor. $180,000 per year per reader.
Wow. Okay, and he sold that, so that's probably good. And he's also served as a board member or advised a variety of other organizations, including Global Giving, Monitor Social Capital Market Accelerator, Global Exchange for Social Investment.
Blah, 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 blah.
and many others. There are too many to list.
Including being an esteemed co-participant in the National Advisory Board to the GA Impact Investment Task Force.
Which is what I was going to mention next, but he just did it for me. So John has this, we've been serving on this board since September, and John has the uncanny ability to listen to the chaos of all the voices as we try to come to consensus and say, no, actually, we need to do this. And everyone goes, oh. So that gift of clarity, I think, will come out tonight as John talks about his work in impact investing. So
cool.
Please join me in welcoming John. So we decided 10 minutes ago that we're going to do this in a Q&A format.
I impressed Kathy into service, which is I had a whole speech written down, and I just kind of play you working, and it's in your notebook, many pages of ink, and then beforehand we just did this little video segment, and Kathy asked the questions and I gave answers, and that was much more fun than listening to me talk for a while. So I asked her indulgence to switch.
So he gave me the power of asking questions, which means you have the power too. So if you want to interrupt, follow up. If you don't like this answer, say, hey, wait a minute, and I'll call on you. So there you go. So tell us what you do more specifically than I said in the field of impact investing.
What do I do?
What do you do?
So
What do you do
I'll
every
start
day?
kind of with what the we do, Imprint, and then what I do, which fortunately now, once upon a time, Imprint was a name we had to get because we needed a name for two of us, and now it's 18 people with $400 million, and so there's a we that's not just an I, which has been a good sign of progress. And I actually have, for the first time in 15 years, I have both a job title and a boss, which is a novel experience, because we hired a CEO to run a business last September. So Imprint Capital really does two things all around impact investing. Number one, we take people who are stuck and interested and get them unstuck and moving in impact investing, which is a regrettable necessity. I wish we were only in our second business, which is building and managing custom impact portfolios with and for our clients, which we do. So we've made over 100 impact investments across asset classes, mission areas, about every conceivable way, shape, and form you can imagine, investing in funds as they exist, creating new funds and new products with managers through partnerships, and doing direct investments and all things in between. But unfortunately, before we can invest, often we have to get people unstuck. We do that for three types of clients. So large foundations. So at this point, we've worked with 10 of the 25 largest U.S. foundations who have awesome knowledge, networks, brands, social capital, expertise, all of these assets, and can sometimes be a little hard to work with. Organizationally complex, structurally complicated, used to having things the way they want it. And so the good news is they really drive us to go very deep in our impact sector research. So that's what allows us to use our own capacity and the capacity of foundations to go very deep in sectors like education and learning, food, health and well-being, energy, environment, and vulnerable populations. And so very specific interest, real depth of knowledge and capacity to tap into. Second audience are families. So we work with, could be individuals, a family office. We just are getting started with a 5-generation family, with 47 trustees, and all points in between. And they tend to want to do some combination of the following three things. So number one, I have a portfolio with an allocation. I'd love to have it look more or less the same way structurally, but I'd love the actual line items to be impact items. I want the percentage of my assets going to impact to be significant and rising, but I want to do that in a way that doesn't fundamentally change the financial characteristics, either at a portfolio level or at an investment level. So it's kind of just swap in high quality options. At the other end of the spectrum are people that have very, 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 very specific mission interests, and they want to carve out money, and they don't really care if it looks the same as the rest of the money they invest. It's really all about what they want to accomplish. So the first category are just really portfolio investors focused on impact. The second are what we call impact seekers. It's really, the first is you're really scanning by asset class. The latter is you're really scanning by impact area, and you really need to go deep there. There's some ironies about a lot of impact seekers I can talk about later. The third are people that aren't sure which of those they want to do. They kind of want to try some stuff and figure it out later. So it's more of an experimental carve out. Some want to do some combination of all of those. So we have a family we work with side by side with their wealth advisor that has 60% of their assets broadly towards impact across asset classes, and then carved out $5 million to do affordable housing in East Baltimore. And so that's not atypical for a family. The third are financial institutions. And there are a few of these we work with who are investing their own money. So we work with a large global insurance company. But mostly it's whether large private banks, independent wealth managers, outsourced CIO shops, whose clients and prospective clients really want them to help them do impact investing. And they realize there's a certain point at which their own capacity taps out. which is, they can do maybe, say, the public markets piece. They can pick some good kind of ESG, SRI, public equity managers, and maybe a few things on the private side. But as you get to the more customized, more focused work they need help, it's very important to their clients, and it's very hard for them to do. And so we plug in as really the intel inside. And I'd say that's probably the fastest growing piece of our business, and where we see a really shocking amount of demand in an underlying way. I mean, it's really remarkable and encouraging and scary, kind of all wrapped together.
So which of those three audiences are easiest or hardest to serve in terms of product being available?
So the dynamics are all different, because this is one of the perpetual questions that comes up. Is there too much money chasing too few opportunities, or vice versa? And I think for us the answer is neither, really. If we have mandates where we can do the work, we can do anything. And I think it's really about having the right mandate. So if there's a large foundation mandate and we can go and have flexibility to make direct investments of appropriate scale with the right resources, where we can make the instrument look the way it needs to look, no problem. What gets hard is when people kind of self-constrain and say, well, I need to have a focus on people below this level of income in this small community, and it needs to be in a well-structured fund with a deep track, there's a certain point at which, once you get a certain number of ands, you get to a possibility set of spread. But if you don't have too many ands, you have the ability to do direct transactions, and you can partner with managers in a different way. So if people say, I want something, you say, okay, it doesn't exist, but you know what, I can probably get this investment manager to do it. So let's sit down and work. And I think that grows as our business grows. I think now, frankly, as we have larger clients, our ability to go to the marketplace, now we're working with one of the world's biggest bond managers to say, we want a low-duration ESG product. And now they're saying, okay. And so the ability to expand the market. So they all have their complexity, right? I think in some ways, if one of them were the really easy to deal with thing, maybe we'd have a simpler business model. But they all have.
How much of your business is custom case by case, and how much of it do you get to replicate in the future?
So it's all custom. It's just a question of how much overlap there is in the custom mandates. I'd say, we looked at our investments, and I think it was that last year, I think it was 70% of the investments that we made had more than one client investment, 75%. And I think that feels like about the right mix for us, because if that number got to 90 or 95, are we really listening to our clients and really being customized, or are we just trying to jam them all into the same stuff? On the other hand, if that percentage is too low, we have an unwieldy business model, which means we can't do the work well. That, I think, probably feels about right for us. So it's all customized. It's just the families that want to layer high-quality impact options to their portfolio, that's much more standardized. Because for folks who have an unfilled allocation in real assets and care about sustainability, we have our heat map, we have our scan of the marketplace, we have our top picks. That's a bit more of a straightforward process. For folks that are more impact seekers, that's where it gets a lot more idiosyncratic, because the way people define impact tends to be a lot more personal than the way they're defining financial return. That tends to be a little more generic.
Out of those three groups of clients, who brings the most fun to this meeting?
Good question, and one that's changing. Because I would say, and this is something that's changing for the industry. I think once upon a time, with the exception of, I think, the Kellogg Foundation, that's one of our oldest clients, and from earlier was our largest client. They're no longer our largest client. They're now even our second largest client. And I think what's happened is we've seen growth on all those dimensions. So we have a financial institution client who we were looking at. We just signed up their large outsourced CIO shop, and we were looking at an energy efficiency transaction we're doing, and we said, okay, we may want to throw in like $200-300. So maybe we just do more like 10 or maybe 15. And I think that's a dynamic we're not as used to. We saw the same thing with the new family client, where once again, actually it was a very similar situation, different transaction. But we said, okay, maybe like $1 million, $2 million. Could we maybe do more like 5 to 10? I think that's growing.
It's a nice problem.
It's nice as having within clients and across clients. I think the large foundations are the ones that have been the most stable of where they're at. I think the nature of the mandates in those other two segments are growing.
So why you? Why is a foundation like Kellogg, which we wrote a case study together, so I know a lot about the relationship we have, but none of them have seen it yet. Already had people managing their assets. right? And there's a whole bunch of firms out there that, kind of have played that role. What is it that you're providing that's unique or different from what other institutions could have jumped into, or maybe you're starting to jump into now? What's the specialness of that?
So I think, the real Kellogg is a good example. So their mainstream advisor is Cambridge Advisors. It's their asset consultant. And the way they unlocked $100 million from their board was not this idea of doing kind of mission-related investing, but mission-driven investing. Mission-related sounded a little too squishy, a little too removed. And they're about vulnerable kids. They're not about the environment where there is a little bit more of a robust off-the-shelf product set. They're about vulnerable kids with a particular focus in Michigan, Mississippi, New Mexico, and New Orleans, which means that 50 to 60% of the portfolio plus needs to be in those 4 places. So there aren't a lot of financial institutions that have set up to do market rate investing, deeply targeting vulnerable kids in the areas of food, health and well-being, family security, education, and learning, with an emphasis on investing in Michigan, Mississippi, New Mexico, and New Orleans. Not a lot of choices out there. And to be honest, not a lot of people stupid enough to say, I want to do that. And we were those stupid people. And I think that allowed us to, they got a great deal because we really built a firm with deep research capabilities, lo and behold, in food, health, and well-being, education and learning, family security. Know a little more about Michigan and New Mexico than we thought we ever would. But that let us really develop our craft and practice of how do you do this more research-intensive work. That's what they needed. And most rational people would say, do I want to do one-off, deep, research-intensive work for an institutional client like this? And most people would reasonably say, I want to do highly customized, deeply integrated work for a potentially finicky, idiosyncratic client who won't pay a premium. Does that sound like a good business to you?
So is it a good business?
No. It depends on how you define it.
But you got 18 people now. Tell me about that.
Depends on how you define it. No, I think we've been able to figure out how to make it work, and that's where that mix really matters. Is having deeply sector-focused clients that let us leverage their knowledge and expertise to have a depth of research that asset management fees would never pay for. So if we had to just charge an asset-based fee on the portfolios we manage to pay to have dedicated deep networks and research capacity, first of all, we couldn't buy the networks that foundations have. The ability to tap those for diligence, we couldn't pay for those. We couldn't even pay for in-house bodies if we had to lay that on the asset management fee. So having dedicated revenue for that, getting paid to get people unstuck means our sales and marketing costs are actually a net negative cost because we get paid. We don't go and spend a lot of time chasing people. We have a meeting and they hire us to help get them unstuck. And so we've refined the business model to pay for the level of focus, integration, and quality we think the work needs. I would not say we have managed it as a profit-maximizing enterprise. I think there's a little bit of a faith-based effort that over time, if we do the job right, we build the right platform, that over time the economics will take care of themselves. That may be right, that may be wrong, but I think the way we've done problem solving has been very different. A lot of people in impact investing will say, let me start with a rational economic model. I am a wealth manager, this is how I make money, and I'm going to invest in impact investing as a way to attract and retain clients. That's a rational business model. Or they'll say, being a fund manager, I know the economics of being a fund manager, I'm going to be an impact fund manager, or I'm going to be a fund-to-funds manager. Those all make sense and are rational. We kind of went the other way, which is what is actually building custom impact portfolios required, and how do we have an economic model that finances our ability to do that? So we kind of walked into the other side of the telescope.
Changing topics. Can you tell us a little bit about the social impact bond product that you helped develop in Utah and what that was like?
It was fun. No, this is a case of, it highlights a couple, I think, important things. So I don't know, how many of you guys know Early Childhood Patient Success Social Impact Bond Utah, early childhood education? How many people know what a social impact bond is? Okay. This is a well-trained set of students. So we had a mandate for the Pritzker Family Foundation focused on early childhood education. It was a little bit of an unusual mandate for us, which is it was totally flexible from a financial perspective and 100% focused on impact. And so scouring for opportunities that would have both direct and catalytic impact. And if you think about early childhood education, we have a fundamental problem of what they call a quality gap, which is you have a lack of access to quality childhood education, especially for low-income kids. It's an unbelievably important thing, but it's an unbelievably underfunded thing. So the microeconomic equation is we need to find a way to make it cost less get more quality per dollar, and we need more dollars. We need all of those. We need to be as efficient as possible, as effective, and we need more money all at once. It's kind of a tough challenge to solve. And social impact bonds are an interesting opportunity to do that because they can bring new money in a way that's aligned with being efficient and effective, a kind of a bang for buck mindset. And so, we ran across some data about intervention in Utah that had been published by Voices for Utah Children that showed this remarkable intervention that over the span of basically 3 years repaid its investment through savings in special education. When we just saw that study, we said the raw potential to do a social impact bond, this is worth digging into. So we called them and they were, shared their data and they said, well, we've actually been approached by a large financial institution and which turned out to be our co-investor Goldman Sachs. And so we kind of all sat down around the table and started working on a transaction. And all was going great. We were really excited. Proved intervention, amazing, great economics, wonderful. And then we had a little bit of a problem, which is inconveniently the state of Utah declined to pass the enabling legislation that we needed. And this was like 2 weeks before we were due to close the transaction. So a slight problem. So we came up in real time with a plan B, which is let's keep the same transaction structure. Let's just have the payer for the first tranche. So this was a 6-tranche transaction aligned with 6 school years. So let's have the payer, the repayer for the first tranche, instead of the state of Utah, let's have it be philanthropy. Let's have that be the pilot tranche. Let's have private capital model what the state should do, which lets us get rolling and have a pre-existing structure that the state can next year, because they meet once a year, can come back, pass the legislation with the pressure of the dynamic will go from doing this new crazy harebrained thing to now, if you don't pass it, you're taking this away. And it really changes the political calculus. So that was the thesis, and it was one of those exciting things where I feel we got to earn our keep by being flexible, creative, nimble, in a way a lot of our mandates don't let us be. I mean, I think the folks at Crystal were just awesome in the work they did and that they let us do, to really be there to move at the speed of deal, which is something a lot of impact investors can't do. And that's a problem for a longer discussion about truly impact-oriented investors often lack the capacity and flexibility to truly do their job well.
Is that the irony that you're referring to?
That's the irony I was referring to.
And why do you think that is?
They do 2 things. So, and by the way, the nice postscript. So, got the deal done, funded took the first 600 kids off the waiting list, doing well, and then the governor in the state of Utah just passed the legislation kind of as per hope, and the transaction continues. So kind of the theory turned into practice. So the issue with a lot of impact-seeking investors is, number one, they, for often not great reasons, tie one or both hands behind their back for relatively arbitrary reasons. They'll say, so for example, a lot of foundations will say, I won't do market-oriented impact investing. I only want to do PRIs that qualify as distributions, and I really. They'll also do that from a structural perspective. People say, I only do loans, or I only do this, I only do that. So if you're truly trying to solve problems with capital, you need 2 things. You need flexibility, and you need capacity. And so step 1 is a lot of people will define away their flexibility. They'll do a long list of the things they can't or won't do. Not necessarily for great reasons. It's very ironic that if you're trying to actually seek impact, you say, but I'm going to self-erect these various barriers that stand between me and you. But that's very, 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 very common. I think a second issue is capacity. It takes a lot of work. I mean, that was three of us going full on phone calls with 4 sets of lawyers, like go, with the flexibility to negotiate in real time and not worry about 17 other stakeholders that are going to come back and tell us no. Being empowered to negotiate in real time with a high-capacity team is really, really important. And it took a great team from Goldman working really hard, our team. It took a lot of capacity to do that. And a lot of impact-seeking investors, a lot of them are our clients, they'll have a team of 1 or 2 that are tasked with managing an existing $200 million portfolio and making $50 million of investments a year. That doesn't necessarily make it easy for you to do those kinds of deals, which are pretty labor-intensive.
And part of the problem with that is they can't look at really small deals. So earlier you mentioned that it was a good thing that clients are coming back to you and say, hey, I don't want to do $1 million, I actually want to do 5. But I actually think there's a counter side to that in that a lot of the deals are small. So how do you get the bigger investors involved? And how do you size investments that are of a size that would make sense for them to be involved?
So I think, a lot of it is the vast majority of capital both does and should flow through intermediaries. So we end up making a lot of investments that go in very small sizes of things. We're just not making them ourselves. we're finding great fund managers that are really good at working with early stage companies that are on the ground, that are closer to that, because that's the way we can do a lot better job than if we tried to do that. Some of it's about the economics, which is doing, having a full team do rigorous diligence on a $200,000 deal that isn't going to make enough money to basically repay that cost. That's tough. But there are ways to do that. I think, we found that, Enterprise Housing wanted to pilot a way to green affordable housing. And it wasn't for us to go look at their first $200,000 deal. It was for us to look at their $110 million of net assets, say, we'll make you a loan. No problem. So some of it is you want to write a smaller check, find an easier way to write that check. And so I think the idea that everyone should be small ticket direct investors is generally not a great idea, because that's going to result in a lot of heartache and a lot of people saying, actually, maybe this doesn't work. I think it's really finding ways to write checks to people that can do the work well, and if it's at a scale where you can do the work well yourself, awesome. Otherwise, find someone that's better at it and then write the check for them.
How much education of the clients do you find yourself doing? Do they come to the table in a conversation saying, I understand the metrics, I know how it could work, let's do this deal? Or do you educate them on the mechanics and the metrics that they're going to be looking for?
Now you're talking about in terms of, because step one is being people unstuck. Step two is generating and prioritizing pipeline. Step three is actually making and edging the investments. I think which piece?
I guess from the first piece. So you have someone who comes and says, I'm interested in impact investing. I've heard about these social impact bonds. What is that? Or do they come and say, I know all about this. I've done my homework. Here's what I'd like. How much do you find yourself educating and in that process of getting them unstuck? And how educated are they when they already arrive?
I'll maybe try to answer it from the direction of what do we usually end up doing. So what we usually end up doing is step one is they'll often have a lot of frames, preconceptions, or concerns in their head and kind of deal with that. So one of the first conversations with trustees and chief investment officers is, you're probably thinking I'm another idealistic, well-intentioned person that's going to come and make overly broad claims that aren't very justified, and I don't really know what that like. That's what you're used to in this space. And they usually say, yeah. They say, so that's not the conversation we're going to have. And so kind of getting people out of their frame, of really, this is something that is susceptible to clear thinking and quality execution, and that's the conversation. There's a family foundation we work with that have been arguing for 3 years about how much impact investments do. And the two kind of chief disputers in that conversation, one was an investment committee member who was co-founder of one of the oldest and most successful venture firms in the country that thought they should get to 2%. And one was a family member that's an innkeeper that thought they should get to 100%. And somewhere between 2 and 100%, they found themselves, I think, somewhere between the moon and New York City. And the reframe that was pretty simple was to say, why don't we think about this a little differently? Why don't we say, you have an investment committee that you use today to make your investment decisions, and you think does a pretty good job, it includes both of you, right? Right. So how about we have neither a minimum nor a maximum? Let's not litigate the question of what percentage will we eventually end up doing in a boardroom. Why don't we say we will look at things, and if the investment committee deems them worthy, we'll invest in them, and if they don't pass muster, we won't. If we invest in them and they perform, we'll keep them, and if we invest in them and they don't, we'll get rid of them. And everyone can agree, albeit with very different expectations of where they thought that would end up. So that client, 2 years...
Did they agree on what performance was?
Performance, so we've actually broke it into 3 categories. So category 1 investments were things that are benchmarked, fit into the portfolio to the current asset allocations and benchmarks. Category 2 were things where we took a definable discount that the program budget would have to pay for. And 3 were things that were basically recoverable grants. And so the first focus was really...
So you contextualized expectations by putting things into buckets so that they wouldn't be crossing each other.
Yeah, and that was what was also happening, is you have to give a vocabulary to sort through. People use the same terms to mean different things and different terms to mean the same things, and you kind of got to clear that underbrush away. And so people will say, well, I'm not going to go and make a bunch of direct early stage investments in our portfolio. We don't do that. Well, we're not telling you to do that. So just to kind of clear the underbrush. So 2 years later, the portfolio is 51% invested in impact. And everybody thinks they got their way. It's partially because it's performing well. But the venture capitalist says, I forced us to have rigor and thought and good process. I mean, good process is something we talk about a lot. And it tends to A, be comforting, and B, actually a good thing. And the family member says, holy cow, this is a lot farther than I thought we could get. I think we do a lot of that, is people are kind of stuck in the wrong conversation. So it's getting them to the right conversation. The education we do tends to be just in market reality, like what's out there. You know, because a lot of people say, oh, that's all a bunch of hippie, blah, 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 blah. We'll say, well, this is really interesting. This, you know, we just made a recent investment where, you know, our co-investors were this university endowment, this, you know, people that could care less about the impact, but, you know, they're like, wait, oh, they're really good investors. Or we had this with a very conservative investment committee with a client. We're going through just a set of examples. I kind of was looking, wait a second. I'm invested in that, personally, through my family office. No, they're really good at what they do. You know, just educating, you know, demystifying, educating about market reality. We do very, very little. We do no evangelizing. None. The good news is we've got a great set of evangelizers out there. And what, you know, people need from us is to be kind of sober, thoughtful navigators of actually getting to the starting line, as opposed to trying to persuade them to do something about it. Did that answer your question?
So is there a market for more firms like yours?
Oh, good Lord, yes.
I
mean, the hard part is we were really, really, really lucky, which is we started with clients, we got to learn by doing, and by the time we realized what a stupid business to be in it was, we reached a level of scale and focus that it was less stupid to be in. And I think the hard part when I think about starting another Imprint is being able to invest to get to the scale where we are. If we had to take external capital and we self-funded it. If we had to take external capital and promise them returns, it almost would quickly force you down to, well, let's just launch funds or do this, or to more conventional models, which don't fit the need we're trying to fit. Now, that's not to say that's the only need people need to fill, you know. But I you know, we would love it for there to be more people like us, you know. And I think the hard part is we're very aware of how lucky we were to be able to get to where we are today. But no, I think the reality is there's a whole swath of impact investing that is going to mainstream in a bumpy but relatively seamless way. Anything in public markets. The machinery of sort of mainstream finance is pretty well set up to do that. And clients are asking for it, and they're going to get that figured out. You know, Merrill Lynch's green shelf has 180 products on it. Morgan Stanley's investing with impact platform has 94. You know, they're going to get that figured out. As you get to the stuff that's a little more interesting from an impact perspective, it's just harder for them to do that. And I think that's where you're going to need these solutions that really plug in. And because the other thing we're aware of is, you know, our research and investment team, just doing impact investing, is bigger than the research and investment team for a lot of wealth managers to do everything. You know, and I think that you're going to have to find ways, and this is why we partner a lot. You know, that client that has the $5 million carved out for affordable housing in Baltimore, you know, we're partnering with their wealth manager who's doing the wealth management piece. And we have 3 CDFI partnerships to do the Baltimore piece. You know, this way to work smartly as an ecosystem. Because if you're not using your own or someone else's flywheel to do this, it's not economical and it's not going to work. And so I think some of it is finding these roles that different people can play so that, you know, at the end of the day, the clients get a great solution, even though it may be seamlessly integrated quietly behind the scenes by a couple of people.
Yeah, we talked about that, as you know, in the Impact Investing 2.0, is this kind of multilingual, multi-sector, being able to partner, being able to kind of speak different sectors. Yeah. What are some of the skills that you think are really required to do this?
I say you kind of have given the punchline. It's funny. Once upon a time, I was, you know, this is actually back to the bio portion. So when I said, I ran the most expensive newspaper in the world, you know, it was an advisory service started by this guy, Richard Medley, who's been George Soros' chief political strategist. And so literally talk to policymakers, turn that into an information service for macro investors. 2 audiences that spoke really different languages and were very bad at communicating, but were codependent in a pretty deep and fundamental way. And I hadn't really made the connection, and I was talking to somebody and said, wow, it's amazing how relevant your past life was. And I said, really? Because I always described my career path as being sort of Forrest Gump-like meandering to where I am today. And I thought about it, and actually that ability to listen and understand the frames people are working in, and to respect and speak that language and translate from other languages. Not try to persuade them to view the world differently.
A little bit like teaching social entrepreneurship at a business school 15 years ago.
I can imagine it sounds passing familiar. No, but I think you crystallized it well, and I think it's one of the hardest things. I was talking to a client of ours as we're finalizing the job spec for someone they're going to hire internally to work on impact investing. And the hard part there is it's more different than people tend to think it's going to be. Finance people think, I'm just going to add the impact piece, no problem. And it's not. And I think we find this when we hire and integrate people, that to really thoughtfully, particularly if you have the flexibility. Like if you're just trying to pick market rate funds with an impact, that is a little more similar. But if you're a little more solutions oriented, a little more flexible, and your clients care a little more about impact, it's a different ball of wax. If you can trade off return for impact, that is a complicated, emergent discipline. Our hardest mandates in some ways are the most flexible ones where we can do that. Because it's pretty easy if we have a tight box to fill, we can fill it, or we can build it, or we can say we can't. But when we can do almost anything, it's like if you go to the buffet that just has too many choices, that's its own challenge.
You mentioned now that you're 18 people strong. I'm curious, how does that break down in terms of function, and what are the different kinds of backgrounds that people have in coming into Imprint?
So we have a pretty lean ops team. So we don't take custody of assets. Our assets stay on our clients' books or in kind of dedicated vehicles. We use third party. So we have a very lean operational team. We have a couple people in portfolio reporting. Our client team is 3 people, sort of very small, and everyone else is in the research and investment. And I think when we say research, those tend to be sector and issue aligned, and investment tends to be asset class aligned. And there's some fluidity across here.
Does that mean you bring people from those fields in, or do they come in generically able to do this and they plunk into a focus area?
It's a little bit all of the above. I mean, and keep in mind, a lot of this is adding structure and narrative coherence to something that evolved a lot more, shall we say, organically over time, which is one of the reasons why we hired a CEO to run the business in September. When we started, it was 2 of us in 2007, and we didn't plan to have a business. We really want to have a business. And so we never did that very deliberate process of thinking things through and mapping things out. We're always sort of in denial, like, we're doing a few pieces of work, a few people, but it's just, and that was at a time when people were really excited about this, and we very consciously didn't want to be part of the choir. We wanted to be just the kind of quiet, put our heads down, do our work. We're not going to take over the world. We're just going to do our little sandbox. And kind of kept on going. And at a certain point, you say, okay, I either need to treat this organization with the respect that it deserves. And I used to be the person who would grow and run organizations, and so I know how much work it is, and I know I was doing a really half-assed job with it. And so that's why we needed to hire someone. So as we go forward, it's going to be a lot more coherent. Like our job descriptions are much tighter now, where it's this is the asset class role, this is the sector role. Just they're very specific. But over time, that's us making sense of what we've done and the roles people have slotted into.
You just mentioned that the majority of your people are in the research investment team. Does that mean that you see the majority of your growth coming in the future from creating these innovative, very flexible solutions like the Utah Education and Social Impact Fund?
No, I put it a little differently, which is for us, we have no marketing or business development because there's so much demand. It's all word of mouth. It's all focused. So we don't need to staff up there. What we need to staff up is actually deliver on what we quote unquote sell. And I think that is be able to build and manage these custom portfolios, which have these pieces, some of which are a little more generic, which is have a heat map of the best sustainable and impact-oriented real asset opportunities across real estate, timber, ag, commodities, and constantly have a platform of the best impact investments that can go into client portfolios, and that's the more asset class-driven work. And then there's the ability to do the much more deeply customized work for folks that are very impact issue focused, and that's the sector work. And then having those cross-fertilize in a really smart way. Because at the end of the day, when we're doing a deeply impact-focused deal, the financial chops of the folks that are more asset class aligned are really helpful. If we're investing in a private equity fund that's around sustainability, our energy environment team is really helpful. And so it's less that our future is doing really direct esoteric transactions. That will always be a part of our business. But I think what we're seeing is this proportion of kind of broadly fill out impact-oriented, market-oriented portfolios, crazy deep impact stuff, and a range of stuff that kind of falls in between. I think that mix is going to stay constant. It's not going to kind of veer dramatically one way or the other.
Other questions?
You started your career, you said, in managing consulting, and then you ran this newspaper. How critical do you think these experiences were in moving into impact investing, and how did you make this choice of moving into this field?
Yeah. So, with the benefit of hindsight, I think a couple of things I got from each experience. So, as a strategy consultant, learning the ability to quickly wrap your mind around new things and have a way to communicate, structure, and make sense of a chaotic universe. When we dive into early childhood education or energy efficiency or whatever, going through that sense making, and I think you've probably seen our market maps and market scans and how that works, is being able to sort of visually make sense of this crazy chaotic world is really important, and constantly be able to learn about new things, and deal with new organizations. Consultants, like you have a new client, meet a new set of politics, new set of stakeholders, new set of people. That's very core to what we do. I think that's what I felt I took from that, which is absolutely essential. From the information business, I think took a couple different things. One, the messy reality of running a business. I think that's something I have a huge bias, but to the degree people get a chance to work in an operating business in an area of responsibility where your butt is on the line for delivering something, and I don't actually care what that something is. Making decisions amidst uncertainty. I have a long talk with actually, and I don't mean this to cast aspersions, but with some of our millennial team members about sort of triage. Life is imperfect. It's messy. It's really hard. You have to make decisions amidst uncertainty. You're not going to get everything you want, and you have to make the best of some lousy options all the time. And that's what running a business is. That's life. And even getting to closure on a deal. Just accountability for getting stuff done is a really important part of growing a business or managing investments, and the fact you have to live with the results. And I think that's a big part of what I got from that. Plus that whole, speaking different languages and really listening. And I think we don't say you should, you ought to. We don't have a dog in the fight in terms of impacts we care about. We don't have our clients ought to do this. It's really what are their financial parameters and objectives, their mission objectives, and their organizational context, and has that match market reality? And that's the answer. Be able to just approach with that. I realize it's a little unusual because someone was asking me for advice on a philanthropy advisor the other day, because we don't do philanthropy. And I said, it's interesting, there's a structural challenge in the philanthropic advising business, which is if you're in that often, it's because you care about something. And it's very hard to be an advisor if you care about something, because then it's very hard to listen to what your client wants. And I think that's very, very, very true in this space. If you can't listen to what people want, it's very hard to help them, particularly if you're in the middle of stuff. And so that's a big piece of I think what I took from that. After the business, so in parallel with the advisory business, we have Philanthropic Institute focused on markets and impact, probably from about 2000 to 2005. And so learned a lot about sort of this bubbling up of these ideas.
Mm-hmm. What about the finance? Doesn't sound like you did finance.
Well, that's next.
Okay.
So finance came on the job. So when Richard and I were selling the business to private equity investors in 2005, we said, what do we want to do next? So we want to do something with our Philanthropic Institute, called the Institute. And what's the most reasonable thing to do with your Philanthropic Institute is we converted it into a hedge fund. Because I literally came back, it was from school, it was from some event. And I was telling Richard, God, there's this great entrepreneur, this great this, this great this. He said, I'm tired of you just coming back and telling me all this stuff. Why don't we just raise a fund and invest in this stuff? But, okay. And so we had some very naive ideas about what we wanted to do. We went to the smartest investors we knew who were our clients, who told us how stupid they were, and they gradually got kind of less stupid over time. And along the way, a private credit investment team from one of our clients said, we'd love to talk a little more about that idea you have. And then they said, we'd love to maybe go do that with you. And then we set out to raise about $100 million to do this direct impact credit fund. And I think the good news and the bad news is we ended up raising about $1.2 billion. And the fund has done well. It's just that at $1.2 billion of other people's money, most of whom don't care about impact, literally out of the $1.2 billion, $850,000 of that cared about impact, which was from the Rudolph Steiner Foundation, which is how I met Taylor, who's my co-founder. And the rest was from large institutional investors that just said, great, we like the strategy, we like the team, here's $50 million. And so, but just quickly, it was not possible to deploy that in the impact space. And so I said, okay, I don't really want to be CEO of a large global hedge fund. But I learned an awful lot because one of the smartest investors I ever met was the head portfolio manager there. And it's one of the tests actually we give to people when we're hiring. It's called the whiteboard test. And what he would do is, in a lot of meetings about investments and finance, and John, you're going to laugh at this characterization, is still sit down and they'll have a lot of meetings in shorthand. Oh, we do this, and you get it, you understand this, and there are a lot of not completed paragraphs. And
That's
not
what my students say.
and not shared detail. And I would realize this, I'd have to leave a meeting early. And I'd ask a colleague of mine that was in the meeting, I said, oh, so tell me about this detail. Oh, I don't really understand that. Why didn't you ask? And there's a weird taboo around slowing down, getting clear, getting specific, and asking questions. Because it somehow makes it seem like you're naive and inexperienced. And so what Seth would do, and some guy would be talking, and he'd kind of get this look on his face. He'd kind of go up to the whiteboard, he'd get a whiteboard marker. These are dry erase, right?
Yeah.
And he'd literally have this look on his face. He'd wait, just so that's you. Then what happens? and literally just would get every detail clear and specific. And if you can't explain it simply and in English, there's a problem. And the problem is not with the listener. And I think that was one of the most valuable lessons of investing I ever learned. If you can't distill it down to something crisp and clear that makes sense, and if you're afraid to ask, that's a problem. And so that sort of the real life of the fund was a lot of where I learned about investing. But I'm not an investor at Imprint. I'm the boring client guy who gets to pretend that he knows stuff about investing. So after the fund, I was basically said, okay, I'll spend a couple days a week in the office. Moved out to San Francisco. We had an office there, but was trying to slow down. My wife had also told me that the time it took to take the subway from the Tribeca Grand, where we had the kickoff, where we handed over the keys to our company to the private equity buyers, and going up to Midtown to a suite at the Regency to launch our new hedge fund, that was not enough time to take off. And I think in hindsight she was probably right. And so I was trying to take time off in California, and my wife's theory of we'll have more time together, you'll relax, it'll be great. She saw the practice of me in a bathrobe, unshaven, and that wasn't actually very good for any of us. And literally in the same week, the Kellogg Foundation, Google.org, and a large family office all said, can we pay you to help us figure out this whole mission investing thing? And I said, I don't know, let me think about it. I thought about it, and why not? Interesting, useful. The world was kind of clearly saying you maybe ought to give this a try. And I would trot out Taylor Jordan as a case study. So Taylor I'd met as this very serious voice on the phone for hours, asking more questions for his $850,000 investment in his diligence process than these very large investors that were writing very, very large checks. And so while it was very annoying at the time, it stuck with me. And Taylor had quietly, and Taylor's a very sober, quiet guy that doesn't like to come out to things like this.
No, I interviewed him for that case, and I was like, have I met you?
Yeah, no.
Yeah, he was, I'm at the events, but you wouldn't have met me.
He doesn't even go to events. He tries, yeah. So I would trot him out as a case because he'd built a 100% impact-oriented portfolio, multi-asset, multi-manager, and done it in a very thoughtful way that sounded an awful lot like investing. It didn't sound like magic. And I would bring him out to kind of walk through this with people in a way that back to the kind of demystify people's lens, like he showed up wearing a suit and not dark and after one of those, he said, I'd love to do this for more people than just RSM. And so the I became a we, and we started working on those clients. And then the night before the board meeting at Kellogg, we got an initial approval in May, then final approval with the detailed design in August. The night before that board meeting, Tom Rees called and said, so you can help me go do this, right?
He's the program officer at Kellogg.
And who's now a native of North Carolina.
He is in Nashville.
And I said, what do you mean? He said, you can, I'm going to the board, you can help me actually, do all this stuff we say we're going to do, right? And I said, what do you mean? We're objectively coming up with recommendations to help you navigate this. We're not going to write ourselves into your future. That's not a response. He's like, just stop it. I actually, honestly am asking you, I can't do this. We don't have people that, I don't know how else I'm going to get this done. So either tell me you can help me or I got to figure out what I'm going to tell the board tomorrow. And so thus we got into the execution business. and started hiring and growing, and things really unfolded from there. And so people, a lot of times people want, especially actually when I talk to MBAs, they want the triumphalist. I had a vision on a mountaintop and a business plan, and it just, I was awesome, and it's just, the story is about as far from that as you can possibly imagine. And I think the lesson I try to give people is just be a couple things. I think one, be a little wary of stories that sound too perfect, because they probably weren't quite that perfect. And some people are maybe a little more open to sharing the real story than others. Two, be open to serendipity. And a lot of people are very into planning, which is awesome. Being organized and planning is great, but be open to the world happening. And that's a tough thing for very organized people to sometimes be at peace with. I'm a much more free-flowing person. I'm very comfortable with that. And I think the third thing, and I think this is Tony asked me this earlier. What sort of advice can do? And I said, be in a position where you can encounter market reality really soon. Less time planning, more time doing. Because the odds that almost anything you do, especially if it's new, that the business plan is right, your sense of what customers need are right, your sense about a price, your sense of all this stuff is right, the odds that those are correct are very, 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 very low. So the sooner you can get into market reality and adapt and correct, the better. So a little less time on the drawing board, a little more time in the doing room. I don't know that there's such a thing as the doing room, but on the playing field. Less time in the locker room, more time in the car. Duke is good at sports, right?
Yes, they are. I'm on the board of a small foundation. 15 million in assets we give away, $750,000 a year, stuff like that. I would say we're a little bit stuck in terms of understanding our impact. We don't have any staff. We're all businessmen from different backgrounds. Can you give me a couple examples of how you have helped small foundations get unstuck? Or are we just too small? It's sort of like we just can't help a tiny group like you.
Well, no, so some of it is, I think there is an important part of, on the one hand, I don't want to talk people out of ambition and kind of pushing on boundaries. On the other hand, there is a little bit of the kind of eyes, stomach, kind of what's the right sizing the ambition to what's doable, and I think to what's reasonable, which is one of the other big things. Without program staff, foundations rarely have a specificity of mission that justifies doing too much really hands-on work, which is good news, right? Which is if you have a broad enough mission that hasn't been parsed finely, angels on head of pin style by a lot of professional staff, you have flexibility to pick from the best ideas that are out there, as opposed to have to go through the brain damage of getting exactly what you want in some cases. So I think there's a little bit of a mixed blessing of size. I think in some cases, I guess question for you back is, if I think about two different disciplines, or one or the other are both relevant. One is just saying, God, we'd love it if our portfolio did, in addition to provided for our financial needs, also did some good. Other is, this investment can actually maybe be a cool tool to advance our mission, to complement our grants. Does one, the other, or both of those sound a little more in line with what you're trying to say?
The second sounds a little better.
Okay. And then, what are your programmatic areas? What do you focus on?
Primarily education, disadvantaged kids, probably early. I helped start a company called Right or Rise.
Oh, okay. We're investors in Oscillera.
Oh, okay. Yeah. So I'm excited about that. We have 3 other directors. But to measure impact, to get a sense of impact is very hard.
But yes, absolutely. And a sideline that I was telling Kathy that we can have a fight about later is, I think the effort to try to standardize metrics is, it's too strong to say it's a waste of time, but that it's not, people see it as a panacea that will suddenly make all this easier and better, and I don't think that's true. But what I would say is, if you have areas of coherent focus, pairwise comparisons at least makes the conversation doable. So if you look in there, so you may say, hey, we're making grants in this area, there might be some enterprise solutions here. Finding ways to have a coherent enough set of things to look at, from grants you're already making, to actually are there ways we could have written a different check to do the same thing, that accomplishes as close to the same thing as possible, is one way to make the conversation a little more real. Because if you've done what you've done, you have other, you may be the kind of guys look, if we find something we want to do, we know how to make an investment. That's no problem. It's just we're a little stuck. Is that?
Yeah, that's probably.
Yeah.
Probably.
I mean, we don't need it. This investing thing's fine, but like, So I think there it's scaffolding the conversation so you get it tightly defined enough so people actually have something to react to. So pick a discrete enough area of activity, hopefully something where you do, folks feel they have enough experience under their belt that to the point of the metrics are helpful scaffolding for the conversation, but they're not going to answer it. But to the degree you've been